Alibaba is very much dependent on importing U.S. goods. They are dependent on also a global customer base. Things like AliExpress now boasting over 120 million users around the world. Their interest to expand Alipay globally, and so they do view themselves as an integral wheel in the global trade balance, and therefore feel that they are very much affected by the trade movements. And then, as you see in Joe Tsai's statement, trying to kind of put themselves on the right side, meaning whatever side is the most applicable to each one of those verticals. So protecting IP, protecting, digitizing the Chinese economy through some of their partnerships with things like Starbucks and Olema, and then obviously the improving the trade deficit. So they are probably the most vocal on this, but I think you'll start to see more of a trend here.
And Krish, we're seeing estimates now on the impact to Apple if we do indeed get these new tariffs of 25%. I believe you're calculating an 11% hit to EPS. JP Morgan has 14%. What do you think Apple's going to do, particularly around iPhone pricing, passing that along or just taking the margin hit? And what should they do?
Yeah, it's a great question, and I think that's kind of been one of the biggest challenges right now. The two scenario analysis that we did was one where Apple absorbs the cost, and there's no pass along to the consumer. In other words, their cost goes up by 25% because of the tariff. In the second situation, we assume that they actually pass it on to the consumer. In that case, the risk is there might be some demand destruction where consumers will be turned away by the fact that the pricing of the iPhone has gone higher. Obviously, what is interesting is in the first case where Apple absorbs the cost, that is the biggest hit to earnings per share for next year, compared to the point where they do pass along, even if there's some modest demand restriction of, let's say, 20%. So I do think that it'll be interesting to see how Apple does go along with it. The one other variable which you folks highlighted earlier in the program was how the Chinese consumer is going to react if these trade wars continue. Most of our focus was on how it impacts the U.S. install base and the U.S. consumer base, because that's where the tariff really flows through for Apple.
Ben, you're joining us from Beijing. In terms of what the sentiment on the ground is there, especially among the investment community, I mean, they're also, in addition to all the talk around tariffs and what this means in terms of a bigger, more impactful trade war, there's also a crackdown in terms of investment by Chinese investors, Chinese companies, into U.S. companies. What is the sense there?
It's certainly taking its toll. I mean, FDI has crashed this year. Chinese investment on venture and growth stage kind of technology into the U.S. has also essentially collapsed. FACTA and CFIUS now are really facts of life for Chinese firms, especially those that have U.S. dollars that are provided by government entities, SOE-backed funds. And so we've seen now a shifting of a lot of those dollars going more towards domestic investments within China, as well as expanding into other emerging technology markets like India and Southeast Asia. And so I think today the view is that some firms that already were very mature in investing in the U.S. have seen kind of the way cleared out for them because they have good government relations teams and they understand how to navigate the regulatory landscape as it shifts beneath their feet. But those that were a little less sophisticated now are essentially blocked in investing in the United States, especially those with kind of strings attached to their money, and so they're seeking markets elsewhere.